helps in case you got a leaf blower or dog barking. For any matter where we have debate, we'll do it in a very organized fashion, so we're not talking over each other. I'll call the roll, and you will each have a turn. And go ahead and interrupt if you want to. That's fine. But just for formal matters, let's stay organized. But don't hesitate to butt in and interrupt if you want to. Just minimize that. So as Andrew always reminds everybody, slightly different etiquette. If you're going to interrupt the presenter, just kind of cough or say, "Hey, can I ask a question?" Sometimes it's better to ask the question right in the middle there. But in general, if it's worth waiting till the end and we call your name, that's a little better. There are no sunshine items to be waived. So I guess we're on to the first item, which is the consent calendar. Is there any items that any of the trustees want to pull from the consent calendar? No, that's great. Can I have a motion to approve the consent calendar?
Motion to approve.
That's a motion by Dick Santos. Do I have a second?
Yes, this is Howard. Second.
Oh, hi. For the record, let the record reflect that Howard is on. Howard has seconded.
Hi, Drew. Sorry.
Oh, no, you're fine. You're fine. We just got started a minute ago, Howard. You're just fine. So that's a motion by Dick Santos, second by Trustee Howard Lee to approve the consent calendar. I'm not going to read the roll. Andrew, how do you vote?
Yay.
I'm Drew. I vote aye. Sunita?
Aye.
Howard?
Aye.
Ashvar?
Aye.
Nick?
Aye.
Dick?
Yes.
And Franco?
Yeah.
And the record should reflect that Vince is not on, and we know that he's going to join midstream. Great. So give me a second, scroll. So we're on to investments. Prabhu, take it away.
Thank you, Mr. Chairman. We have two items this morning. The first is presentation of the calendar first quarter private equity by Neuberger, followed by June 30th performance reporting by Makita. I do have unofficial numbers for those who are interested. These are estimates. In July, the plan returned 3.91%, and in August, 2.47%. Of course, these are estimates, and we will get the correct numbers a few weeks from now. Without further ado, I'm going to turn this over to Casey Boyer, if she is here from Neuberger.
Yes. Can everyone see and hear me?
Yes, we can.
We can, Casey. Thank you.
Okay, great. Well, it is good to be here again. Appreciate the opportunity to present to the board, not just quarterly, but appreciate the opportunity now to do it through Zoom so I can see everyone's faces. Just to start, the presentation that you'll see today, the presentation that you'll see today is a little bit different from past quarters. We updated some of the formatting and some of the detail of the information just to make it a little bit more relevant, easy to read, and to give a little bit more information in some of the sections. So I will walk through that today. The last time I spoke was back in June, and that really was still in the heart of COVID unknown. So we had some early information on what Q1 performance would look like, but didn't have it finalized. Today, we obviously, and I will be presenting the Q1 information, but we also do have a pretty good idea of where Q2 performance will come. So if we'll turn to the first page, which is actually page 2, this gives a good overview of the private equity investments within your portfolio. First column being the legacy investments, which are all the private equity investments that were done prior to the strategic partnership that we've developed which we have in the middle column, and then a combined. So I'll just give you a few key kind of points of the market quickly. When you're looking into the private equity and private markets, obviously it does kind of relate to public markets, but it is different. So what we've seen so far in terms of deal flow and private equity investments coming to market, there was obviously a very quick pullback in April and May. Deal flow activity very much did slow down. However, we have seen a pretty quick recovery in that part of the market. Deal flow has remained and come back to kind of a robust format. What I would say is there is very much a bifurcation of kind of the covert COVID winners and losers within companies. So companies that have performed well during this environment and have really proven themselves, they still are kind of at that higher price point valuation, even similar to what we were seeing prior to COVID. And then, of course, the companies that are, that haven't performed and maybe the COVID kind of brought out the weaknesses within the company. Obviously, those types of companies are not coming to market right now. So there's definitely that bifurcation between companies that have done well and those that have not done well. So how that's played out in your portfolio for Q1, the portfolio was down, and I'm talking specifically about Neuberger, about 8% overall. So if you look at the net multiple, currently at a 1.1 times, if you take that out another decimal, it is 1.08 times. And at the end of 2019, comparing to the quarter previous, it was 1.14 times. So obviously still rounding to 1.1, but there was difference there for Q1. Now, for Q2, we've actually seen a very quick rebound within the portfolio. This has been something that has been very different, I would say, than historical recessions or downturns. So in the GFC, it took a year and a half to 3 years for portfolios to rebound. Valuations have come back and performance has come back fairly quickly. So for Q2, we're actually estimating that your portfolio could be up around 10%, which would actually bring it back to around the Q4 2019 performance. Turning to the next few pages, page 3, this shows the underlying investments within your portfolio of the legacy investments and really highlights the benchmark and how those funds have performed against their peers. If you look on the far right, you'll see in terms of IRR and MOIC, which is multiple of invested capital, and kind of where those funds are performing based on their peers. So third, second, fourth, and first quartiling. That is the same for page 4, and I won't go through each one specifically. On page let's see, on page 5 and 6, this is the Neuberger portfolio. Again, you will see the quartiling metrics. One thing I would point out is all of the performance on these pages are for the funds themselves, for the investments, are as of March 31st. So you are seeing that those markdowns within the portfolio. The benchmark is actually as of 12/31/19, simply because that's the fastest that benchmark comes out. So it is a lagging benchmark, which means the portfolio is actually being benchmarked by the past quarter, which did have better returns at that point. So you'll see it's not quite apples to apples, and that's kind of industry standard. Unfortunately, the benchmarks lag a little bit. And if you turn to the next page, page 6, you'll see there are some investments that still do not have benchmarks. Those are still too early in the life of the fund. Many of them haven't made an investment yet. They may be only 9 months into the fund and have not quite entered that period where you can benchmark them. So we will add those as that time comes. Page 7, the next page is actually a page that we added for this new formatting that I think is very helpful to show your exposures based on committed capital as well as invested capital. So as you all know, we commit capital to funds and they then invest that capital over time, 2 years, 3 years, even 4 years. So what we actually have committed may be different than what has been invested to date. And you'll see that in the first line, which is based on investment type. So a primary fund investment where we're investing into a private equity fund. We show that on the far left, we show the committed, and then you'll see on the invested capital pie chart in the middle, the primaries are actually only about 50% of the capital that has actually been invested into portfolio companies. Co-investments are investments going directly into a company, so that capital is deployed and invested immediately. So that's the difference you're seeing there. I would point out that on the committed capital, the co-investments and secondaries, those currently account for about 22% of the portfolio. We still have additional capital to commit there. So it will get closer to 30%, which is kind of what we have been focused on and getting that capital deployed. And then on the far right, you'll see the combination of the legacy and Neuberger program. The bottom shows what the breakout is and exposure is by geography. Again, you can see the difference there in terms of what we've committed. Europe, rest of world is about 25% on a committed basis, which is pretty much in line with what we would expect. It may go up to 30 or 35%, but in terms of invested, it's a little bit less. And the next page is another page we added, page 8, really just to give a good overview of performance. And we've also added the benchmarking, which is the second table kind of on the bottom, the longer one. And this benchmarks the actual Neuberger partnership program against its peers. So we've shown two performance metrics here. We've shown Q1, which is the current performance. We've also shown Q4. So you can see the difference there between quarters. And then we've shown the quartiling at the bottom. And you can see that when you compare the Q4 2019 performance to the benchmark, which is also Q4 2019, it is currently at a second quartile and on an IRR basis, and a first quartile at the TVPI basis. You can see we just missed the IRR first quartile by 0.2%. So we will work to get that up to first quartile, and hopefully we'll see that relatively soon. So the next couple of pages, 9 and 10, I won't go through those specifically. It's very detailed information at the portfolio level of all the investments, legacy and Neuberger, as well as kind of the split out between those two and the performance for each one of them. And with that, I will open it up to questions.
This is Sunita Ganapathy.
Sorry, Casey, I was on mute. Let's go ahead. I'm going to go down the roll for any questions. Andrew, do you have any questions for Casey?
None at the moment. Thank you.
Great. Sunita, anything you want to jump in with?
Yeah, sorry, I think I jumped the gun on my comment. But I do have a question for Casey. I guess I'm just curious I follow the public markets more than the private markets. So the public markets, if you look at year-to-date, value funds have really, or value indices have really underperformed. I'd imagine that the private equity portion of this portfolio is more correlated to that. How do you explain that in Q2 you're expecting that you're back to a Q1 end of year type of return?
Yeah, so it's the performance over Q1 and Q2 has been very different across the board, I would say. So if you kind of, when we broke down the performance and looked at it, kind of analyzed it through different avenues, it was different. So when we looked at the difference between geographies, and as you know, in the private markets, the funds are producing valuations. They obviously go through with their auditors and kind of figure those out. Obviously, Q1, most of them don't have an official audit, but they do typically use third-party valuation companies that help them value. When we looked by geography, Europe was down more than the US. That was primarily due to some of the regulations they have in place in Europe, where private equity funds were more conservative, probably conservative than what they needed to be. And then you would also see differences between large cap buyout valuations compared to smaller buyout valuations. So obviously large cap firms in the private market are more heavily tied to public markets. And therefore, when they were doing valuations, they would mostly be using public comparables, and therefore their valuations would be more tied to that. However, mid-cap buyout is a large part of our portfolio as well. And those companies are smaller companies, more family-owned companies that aren't as tied to the larger kind of public market. And therefore, some of those mid-cap buyout funds were marking down, but probably not quite to the extent that some of the large cap funds were marking down. So I guess the overall summary is private market valuations are not all consistent. While each private equity fund normally is somewhat conservative, they also are making sure that they are not overly writing down their companies just because of an event, not necessarily because the companies were performing badly. So we do believe that a lot of the companies have performed well. A lot of our portfolios are very heavily weighted toward technology, which in this time period has not seen much of a decline. So I do think there's a lot of factors, but it is something we were not expecting. We did not expect for it to return this quickly, but we do follow it very closely and make sure that we agree with where GPs are marking their companies.
Hey, Casey, maybe this is Brian. Maybe there's something I'll just add to that.
Yeah.
When we look at just analyzing the historical performance of private equity versus public equity indices, we don't necessarily see a greater correlation to value indices than growth indices. I think that what private equity is generally trying to do is find those subsectors that can achieve higher top line growth than GDP level or value type companies. And while certainly everyone would like to pay lower multiples and get those disciplined companies, I think in particular, the way we've started to construct this portfolio is towards those higher growth opportunities without going too far out on the risk spectrum. So that's probably why, in addition to the valuation methodologies that the GPs are using, why we could expect some bounce back greater than that of public market value index.
Okay, thanks. That was helpful. I mean, I do appreciate what Casey's point that perhaps Q1 valuations for some of the mid cap were not as steeply down as the rest of the market, and also the point you made about growth. The rest of it, I'm not sure. I agree with you, Brian. Perhaps in the long term, there may not be much correlation, but I'd imagine that's the only valuation benchmark out there at this point. But point taken. Thanks.
Yeah.
Anything else, Sunita?
No, that's it from me.
Okay, thanks. Trustee Lee, Howard, do you have anything you want to
Hey,
ask?
Drew, can I jump in real quick? This is Andrew.
Oh yeah, go ahead.
Casey, I apologize for this. Some of your messages is coming back pretty garbled. Just to try and play with and trying to fix it up, do you mind turning off your video feed to see if there was a bandwidth issue, and that maybe that'll clear up your conversations?
Sure.
Thank you. Thanks, Drew.
Oh, sure. No worries, Andrew. Howard, do you have any questions you want to ask?
No, Casey, thank you. I'm good for now.
Eshvar, do you have anything you want to jump in with?
Yeah, thank you, Drew. So a couple of questions. So one is, I think you mentioned verbally the performance numbers, Q1 -8 and Q2 +10. The presentation, though, you show it more as a, the cumulative IRR and MOIC. Does it make sense to kind of, when you're doing the quarterly report, to kind of print the aggregate performance number, just so you can see it? Otherwise, somebody reads it has to really go back to the last quarter and look at this quarter and kind of back out the numbers.
So we do have the performance both quarters on page 8 at a net basis for the overall portfolio. But happy to add to that if it's helpful.
Yeah, I'm thinking just like the quarterly print for the private equity portion of you see what I'm saying? Like, where is the -8, in this presentation? I don't see it anywhere.
Yeah, we don't have that number specifically, but we can.
Yeah, I mean, I think it's useful, especially when you go through this volatile environment.
Yeah.
Okay, just a suggestion.
Yeah.
The second question, I guess both for you and Brian, if I, in some seminars that I've taken part a month ago, everybody was talking about 2020 and maybe even 2021 being a great vintage year for private equity, because, valuations are probably attractive. But just given that things have bounced back, have those opportunities disappeared, or are things still interesting for new investments you're making?
So from my point of view, very much still interesting. So one thing I did mention earlier, which I think is very true, is you know, there definitely have been winners and losers. The winners are still very much, you know, sellers of those winning companies are still very much expecting higher multiples and higher valuations for the companies, which we have found as we've been doing diligence on those quote unquote winners is they are very good companies. So I think the valuation expectation is expected and is in line with what you would pay for a good company. What I think has happened is that will be good moving forward are some of those companies that do need more work. Instead of paying that higher valuation that we, you know, that people are asking for previously, I think those will come down. A lot of those companies, it takes more work, but private equity firms today are, you know, very much value buyout firms that have huge operating committees and operating teams that can handle that. So it's very much making sure that the company you're purchasing really warrants a higher valuation, and making sure that the companies that need a little bit more work, you're paying a fair value for. So I think there are going to be great opportunities in the next couple vintages, which falls in line with a lot of historical performance of, you know, 2009, 2010 being good vintages as well.
Yeah, I would generally echo that sentiment. I think, you know, this is where the diligence on the particular manager becomes very important also, because you know, there are managers out there who might gravitate towards building portfolios that I would say are similar to public markets in the sense of chasing things that have not been as affected by COVID or have bounced back rapidly. And there will be those who are really looking for those affected industries. And I think that as we construct portfolios, both on a primary fund basis and through co-investments, we'll be making sure that we have a balanced approach to our exposures.
Again, last question, are there more co-investment opportunities than usual, just given maybe some companies have that extra financing need?
So I would say, I mean, if we look at our deal flow for year to date 2020, overall, it has been down, but that's simply because of the slowdown in kind of April and May. When we look at what we have received in terms of deal flow for co-investments, starting in even June, July, August, our average deals per week is actually up. So in Q1 2020, we had approximately 6 deals per week. And recently in the last few months, it's been 8 deals per week. So it's a combination of the market, but it's also a combination of the fact that for, you know, for us as a platform right now, private equity firms want to partner with co-investment partners that they know can fulfill transactions and do that in a quick and efficient manner, as well as properly diligenced. And so they are going specifically to partners that can do that. So if you further break down our deal flow, the kind of run-of-the-mill co-investment is a co-investment that is handed to a co-investment partner post-transaction. That's your typical transaction. That amount of deal flow has gone down. The deal flow we have seen increase is actually in the what we call co-underwriting transactions, where we are actually partnering with a private equity fund prior to the inking and closing of the deal. So we're able to do diligence alongside of them prior to the deal closing. And we're being brought into even more of those processes because they really want assurance that they will be able to close. So I think parts of the market are down, part of the markets are up. Luckily for us, through our platform and relationships, we've been able to capitalize on that part of the market that is up.
Okay, thank you, Casey. That's all I had, Drew.
Thanks, Ishvar. Nick, do you have any questions for Casey? You might be on mute, Nick. I'll take that as a no. Dick, do you have any questions for Casey?
No, thank you.
Great. Vince, as we noted before, will join us at some point. Franco, do you have any questions for Casey?
No, no questions.
No, great. And I don't either, Casey. Thank you. That was really helpful. Oh, go ahead. Yeah.
Sorry, I had a question I wanted to ask. Sorry, am I out of order?
No, go ahead, Howard. You're doing this exactly right.
Okay, great. Casey or Brian, I just had a question. I was actually looking at the Makita data, I guess, for the overall plan, and they mention in one of the slides, Cambridge Associates has their PE index for Q2 20 as minus 7.6%, so it's down. But Casey, you mentioned earlier that you estimated Q2, the portfolio, to be up 10%. Is there a way to understand what the difference is?
I'll jump in there. So I admittedly don't know which data point on the Makita presentation that you're talking about. I imagine we'll see that next, and hopefully I'll be able to answer it at that point.
Okay, yeah, it was one of the benchmarks on slide 20 of the Makita presentation, where it talks about all the benchmarks and it mentions Cambridge Associates as other. Yeah, maybe we can get to it then and hold off. Thanks.
Great. Thanks, Howard. Back to you, Prabhu. You on mute, Prabhu?
I was, thank you.
Yeah, quite all right.
And so that takes us to item 2C, Private Markets Report by Makita. I'm going to turn this over to Laura Wyrick.
Great, thank you. Good morning, everyone.
Hi, Laura.
Hello, hope you all are well. I'm going to share my screen here. Can everyone see it? Yes, okay,
Yep,
great.
We got it. Thanks, Laura.
Great, thank you. Okay, so I'll be relatively quick since that was a great presentation by Casey of Neuberger and lots of good questions. Taking a look at page 2, you can see here where we show the account type. So legacy private equity was before Neuberger came on board, and then the Neuberger Berman Fund of One, the private debt program, real estate, and real assets. And one thing that's relatively new on this slide is something that some of our clients have requested for some time, which is in the far right column. It's a public market equivalent IRR. So if you take a look here, that's taking into account daily valuations in the public markets when these private market underlying partnerships called and distributed capital. So the PME is what you would have earned in the public markets if you put your cash flows to work at the same time and they were distributed at the same time. So you can see here, you know, really a story of the internal rate of return for your program being stronger than what you would have earned in the public markets across all asset classes, with the exception of private debt, where it's pretty close to what you would have earned in the public markets. But if you recall, private debt started out with 3 very large commitments that were designed to really be opportunistic back in 2009 and not even really be private debt. but now they're classified as part of that program as well. And more recent private debt commitments have been performing much more strongly. Taking a look at page 3, we start out with the private debt program here, a nice graphical representation of vintage year diversification, especially in the past few years with commitments scaling up over time so that we don't put too much to work at once and have exposure to different market environments. And I will skip ahead to take a look at the underlying partnerships here in private debt. And as I mentioned, those top 3, GSO, Medley, and White Oak, were committed to by a prior staff as sort of an opportunistic allocation coming out of the global financial crisis. And you can see, they've had positive returns, but they have not been nearly close to the peer IRR. These are more direct lending funds rather than opportunistic private debt. But if you take a look at the private debt funds that have been committed to and now have meaningful performance, say from 2015 to 2017 under your current staff, Octagon, Cross Ocean, Aeromark, those funds are performing quite well and exceeding their peer benchmark returns. You can see the exposures for the private debt program on page 7. And you can see a decent amount of diversification by vintage year, which is what we want to see and why we put in place pacing plans that the board approves each year. You can see a bit of a geographic focus bent towards Western Europe because of a couple of the recent commitments, but also significant exposure in North America as well. In the real assets program, starting on page 8, you can see here that there were some commitments back in 2016, and then a small one in 2017, and then a bit of a lag until 2019. This is a program that is relatively immature, but has been scaling up recently. And I'll take a look at the partnerships that you have here in real assets on page 11. The first one being Brookfield, which is significantly outperforming its peer internal rate of return for other similar funds in that vintage year. GIP3, which we still have confidence in, not yet posting too much of a return. And then we have Lime Rock, Kimmeridge, and Global Infrastructure Partners 4, all of which are too new to be posting meaningful performance yet. So a relatively immature program, but one that we're still working on putting together along with your staff. You can see here that most of the exposure was in 2016 from those 2 infrastructure funds, Brookfield and GIP. Most of the exposure is global. And then we take a look, moving on to real estate. So real estate is a program that has been committed to regularly over time, but there was a long period where there was really just one new fund every 2 or 3 years that was very diversified. But with your current staff in place now, we've been scaling up the program with more specific allocations, which you can see here on page 16. You see 4 funds that are all new as of 2019 and 2020 that don't yet have meaningful performance. But prior to that, we often were doing sort of a DRA diversified fund. DRA 9 here in 2017 has had performance of almost double the benchmark thus far. We then move into exposure. Most of the real estate exposure is in North America. It is relatively diversified by vintage year, and that's something that we're planning to continue to maintain based on the pacing plans approved by the board. The last section of the report has a lot of information on the market environment. Of course, because this is a lagged report, as you know, private markets post their performance at least a quarter after public markets, and the market environment has changed. But I will let you peruse the private markets environment slides at your leisure, should you be interested. So I'm happy to take any questions on the private markets report.
Great, thanks. Laura, Andrew, do you have any questions?
No question. Thank you, Laura.
Great. Sunita, do you have any questions for Laura?
I don't. Thank you.
Howard, do you want to ask that question again?
No, I'll ask it. It'll show up on the next set, but I do.
Oh, that's right. Yeah, sorry. My bad. Any other questions,
okay.
Howard?
I do. On this one with either Laura or maybe Prabhu or Brian, with respect to the distressed debt, or distressed situations. Is there any point of view on how that might play out for the portfolio? Because I think at the conference last week at Pension Bridge, there was a lot of talk about shifting from dislocations to the distressed opportunities. And do you have a point of view on that, or are there any triggers that you see going forward?
Laura,
Yeah,
do you want to give your view first?
Sure. Yeah, I think over the past probably 10 years, there's been a lot of talk about distress, coming back at some point. One thing that we think is interesting is sort of contingent funds where clients commit and the manager only calls capital if they find opportunities. You do definitely have some exposure in your portfolio to managers that can take advantage of distressed situations. But I'll let Brian speak to the specifics.
Sure. So, to be honest, I've spent a lot of time over the last few years doing exactly this, is researching. Obviously, public credit markets have looked mispriced for some time, and that continues to be forgiven. And there was a moment in March, obviously, where all markets dislocated, and it looked like we are going to go through one of the better periods in recent past for distressed credit, only to find that markets bounced back fairly rapidly. What happened during that time is it started to become very clear that there was a bifurcation between managers who were largely pursuing liquidity-driven strategies. So they would buy credit that was less expected to restructure and more just depressed in pricing because of a need to sell. Historically, the way I've approached distress strategies for the police and fire private debt portfolio is to target managers who are operating in smaller capital structures and have the expertise to actually sit in a creditor committee and try and get a company through a process rather than just trade credit.
Anybody else want to jump in on that? Anything else, Howard? Howard, I think all we're hearing is static, so I'll assume that's you're done. Eshvar, do you have any questions for Laura?
Yes, yeah, thanks, Drew. So Laura, if I look at page 2, I just want to clarify what you said. And let's take the Neuberger Fund of 1, IRR of 8.1 versus a public equity equivalent of minus 13.3. Does that mean that if at the same time you invested in, I'm assuming it's a Russell 3000, the return would be an IRR of minus 13.3?
So that means that every time that one of these underlying funds called capital, if money was invested in that index, and every time they distributed capital, money was taken out of that index. So it's really a daily valuation. That's what the return would be.
And then is it apples to apples? Is the Fund of 1 valuation end of March, or is it end of 2019?
End of March.
End of March, okay. And then, so question for Dinesh maybe, I think people talk about the K curve in terms of what's going on in the economy. And I think it's most apparent in the real estate, right? I mean, some suburban homes doing well, New York, San Francisco, not so well. Hospitality is, clearly on a big downward slope. Maybe multifamily is okay. I mean, how do you assess the opportunities in terms of both sides of that K curve right now? Or, and I'm not thinking short term, but over the next 5 to 7 years.
Yeah, and I think that's something that there's still a lot of question marks and things that are yet to be seen. So we're still monitoring how these trends are going to play out. And I think there is some data that shows that there is a flight out of urban cities to more suburban areas. And it's still yet to be seen if that's going to be a long-term trend or temporary. So I think the way that we're approaching it is to look at more direct opportunities where there's something that's more unique to take advantage of an opportunity set, such as buying assets cheaper than what they're worth and having multiple opportunities to profit from it. So not just making a bet on suburban versus urban, for example.
Okay, thank you. That's it, Drew.
Thanks, Ashford. Nick, do you have any questions for Laura? Nope. That looks like a no. Dick, do you have any questions for Laura?
No, thank you.
Franco?
No.
Nope. I don't either, Laura. Usual great job. Back to you, Prabhu.
Thank you, Mr. Chairman. And then we will move on to item 2D. I will take the baton from Laura and hand it back to her.
Let's see here. Let me find this report. All right. Can everyone see this all right? Okay, so the quarterly review. So this is as of June 30th, and looking at the world markets here, just to lay sort of a backdrop, you have all asset classes positive, which was obviously a major contrast to the first quarter when we had a major correction.
Hey,
So-
hey, Laura, hang on a second. I
Oh,
think I'm
are you not seeing it?
Yeah. No,
All right, let's see.
Pull
I
up
see it,
the
but I
report.
bet I can find a different way here. Oops. Let me find,
Yeah, I think you're still broadcasting the previous
yeah.
training.
Let me see how to.
Back to Zoom re-education
tab.
camp for you.
Try to get it the right size here. I normally have my my trusty sidekick, Chris Theodore, to help out, but he is on vacation this week, so I'm on my own. So in terms of world markets, if we take a look, can everyone see the colored bars? Of course, today we have some more volatility. Markets are down where we sit right now. But if we look through the end of June, small cap stocks were up 25% just in the quarter. The Russell 3000, which is all US stocks or a broad swath of US stocks, was up 22%, followed by the S&P 500 up over 20%. Emerging markets stocks did better than developed markets. If you see the orange emerging markets bar was up 18.1% in the second quarter. The EFA index, which is developed international stocks, was up just under 15%. And then you have that followed by REITs, high yield bonds, emerging markets bonds, and then hedge funds. Even, commodities, high grade bonds were up almost 3%. One thing that I think is interesting on the next slide is the huge difference, if we look especially at the 1 year period, between capitalizations and styles. If you take a look in the 1 year column at the Russell 1000 Growth Index, that's large cap growth stocks, that was up 23% for your fiscal year. The Russell 2000 Value, small cap value stocks, was down 17.5% for the fiscal year. So that's just an enormous dispersion between large cap growth, which, as you all know intimately, many tech stocks sort of leading the way in that space, and small value. I will skip ahead in the interest of time to your performance specifically. We have the watch list, as you know, nothing in particular to note there. Dimensional EM value has been underperforming. As I just mentioned, value stocks have been beat up sort of inordinately. Blue Bay EM debt is a manager that we're evaluating along with staff. We're talking about the composition of emerging market debt in depth lately, and I would expect to see some updates there soon. So I will skip to your fund specifically, which had a market value of 3.7 billion as of the end of June. I think you all are really a sort of poster child tale for rebalancing at the right time, March 18th, and then executing it in the few days after that could not have had better timing. If you take a look at the current allocation, it's very close to that new policy that you adopted in March with more equity. Looking at individual fund performance, so your fund, your plan was up nearly 10% in the second quarter of 9.6%. For the fiscal year, which I'll focus on because that's obviously a major important time period for you all, the total fund was up 3.1% and outperformed every benchmark that you see here. So outperformed the investable benchmark portfolio, which is what you could have gotten in public markets, which was at 2.4%, outperformed the low-cost passive portfolio, which barely would have been positive, and the 60-40 blend, which would have been up 2.9. The liability benchmark portfolio, if you recall, is long-term government bonds, which have done quite well for the fiscal year. So that did have a return of 25%. And then if you look at the peer median return, it was 1.3%. So you had more than double return of the peer median, and that placed the police and fire plan in the 17th percentile, with 1 being best and 100 being worst. So top quartile performance for the year-to-date period, for the fiscal year-to-date. And that also brought the 3-year numbers back closer to median. And we really saw a lot of broad outperformance across asset classes, particularly in public equity. If you take a look down this page and on the next one, excuse me. And we really saw also private equity returns quite strong. If you see the 8.3% return on this slide, part of that is because the Russell 3000 is holding assets for your private equity program. And then we saw a variety of other asset classes do well. In particular, emerging market debt had a return of 8.7% relative to negative 1.1 for your benchmark. So that placed it in the first percentile. And a lot of that is because you have a long short emerging market debt manager called Wellington Iguazu in that asset class. As I'll mention, most of your managers perform quite well. You had very good stock selection. So I'm not going to go into individual manager performance. I'd rather skip to total fund strategy, which it's easier to scroll on my other sheet, but I will look at overall cash flows. If you take a look, there was a net investment inflow of about 63 million, but also 250 million in net investment change. So you had investment earnings just from March 31st through June 30th of $250 million in the plan. And then looking at attribution, you can see on slide 46 here. So this is the 1-year attribution, and you can see really strong stock selection and allocation effects across your fund for outperformance relative to the benchmark. Being under allocated to investment grade bonds relative to your policy gave you a strong allocation effect, since investment grade bonds didn't do as well as equities. And then you've had really strong manager selection and outperformance across the total fund as well. Taking a look at some of our additional metrics here. One thing that I'd like to point out, I mentioned that the total fund had a performance of 3.1 relative to 1.3 for the peer median. One thing that's also impressive about that is that over that 1-year period, the total fund's standard deviation or volatility was much lower than the peer median as well. The fund's volatility was 10.4 relative to 12.1 for the peer median. So there obviously is a lot of other information in this report as well, but I wanted to focus on the highlights, and I'm happy to take any questions.
That's great, Laura. Andrew, anything from you?
Can you come back to me? I probably have a question in a second.
Yeah, all right. No worries. That then takes us to Sunita. Do you have any questions, Sunita?
No, thank you.
Great. Howard?
Yeah, sorry, my apologies for my audio cut out on the last session. But yeah, if we can go back to slide 26. No, sorry, slide 20 was what my original question. Slide 20 under the other category near the bottom, Cambridge Associates PE index. That's where it shows a minus 7.6. And that's why I wanted to understand how, I guess from our perspective in the original Neuberger-Berman slides, how Q2 might be up for private equity.
Yes, so this, it's a good question. So with private equity benchmarks, the Cambridge benchmark is just essentially a peer median. So Cambridge needs to wait for all of the funds in their universe to report to put out a number. So this number is always going to be on a quarter lag. So even though this shows second quarter of 2020, this is actually the return for the first quarter.
Oh, okay. Yeah, sorry. Yeah, I missed that. Okay, got it. That makes sense. Thanks. And the other question was with respect to cash, do we have a point of view on whether or not we need to adjust our cash position given the low interest rate environment?
So cash is not a target in the plan so much as something that we use to be able to use the overlay and move around. And so the cash that's in the current allocation here is really an artifact of having some things that we're funding and moving around more than I think a strategic allocation. So I don't believe that we or staff plan to hold cash long term.
Any other questions there, Howard?
No, thank you.
That's great. Eshvar.
Yeah, so if I may just follow up on what Howard asked. So cash, our policy benchmark is 0. So, and I see investment grade bonds, we should be at 12, we're at 9. So is the goal to move the cash to investment grade bonds?
Hi, this is Jay. Laura's exactly right. Cash is not part of the strategic asset allocation, and I think the reporting here is kind of an artifact of the way the overlay notional balances are accounted for. So we typically, in terms of economic exposure at the plan level, have cash balances or actual cash exposure of 1% or less because any excess cash is being overlaid. At any given time, I think most of our overlay balances are in the 1 to 3 year gov cred or the ag. And that'll change as we select probably an active core bond strategy later on. But to summarize, that the cash balance isn't actually cash exposure, it's being overlaid through a basket of futures. And the kind of underweight to IG bonds or actually most of the fixed income portfolio right now is actually being covered by the overlay.
Okay, thank you, Jay. One more question. If I turn to page 15, and I think, so we were conservatively positioned, we've added to growth. And I think based on some data that, I guess with presentation material I've seen, is it fair to say that our growth exposure is maybe in line with our peer group?
I think it's fair to say that the growth exposure is in line with the peer group, maybe very slightly higher.
Okay. So then the question is, so it's a good quarter, plus 9.6, but we seem to be lagging the peer median return of 10.1, and the investable benchmark portfolio, which seems to be much higher. I mean, what might explain that?
I think what would explain that is the movement that took place during the quarter. And some sort of tilts in the portfolio. So, there is more exposure maybe to non-US securities and to value, which, even though you had a really strong manager selection relative to their benchmarks, if you had been 100% US or more growthy, that would have had a higher quarter return.
So would you say that our US exposure still lags our peer group, or?
I can actually show you that somewhere back here.
This is
Oh,
Christina, the staff. Can I add something, Laura? Sorry to cut off.
No,
so, okay. So, because we have a higher allocation to emerging markets and international equity than our peers. And if you look at the quarterly return, US has outperformed emerging markets and international non-US. So that's, I think, the reason why we're slightly lagging the 10% median return.
Okay, thank you.
Okay.
That's all I had, Drew.
Oh, thanks. As for Nick, do you have any questions for Laura? Take that as a no. Dick, do you have any questions for Laura?
No, I don't. Thank you.
Franco? I'll take that as a no. Back to you, Andrew.
Yeah, thanks, Drew. I think Eswar and brought up a good point and touched on, and so did Howard in regards to the cash. So those questions were asked because I was looking at the cash balance plus the low beta. It seems like they're both in sort of the basically 90-day T-bills, and so I think you guys have answered that question and caught that. So I appreciate it. Thank you.
Great. So being one of the old gray hairs on the board, I'm going to weigh in. Vince isn't here. So first of all, Laura, let me personally thank you for joining us on that little fire drill back in March and making it such a big success. Prabhu, certainly to you and Roberto and your staff. I'm a venture capitalist, and I guess you think of startups as moving fast, but actually, of course, venture capital is what we call patient capital. And I think one of the lessons I've learned in my life is that you can make a lot of money if you set a plan and you keep your ear to the tracks and you modulate the plan, but you stick with the plan. And so what happened in March that Laura says was so successful first began at an offsite in the winter of 2011 when Vince Zeri stood up and said, hey, everybody keeps telling us we're different, so let's be different. So Laura, I'm not going to put you on the spot, staff, Prabhu, I'm not going to, but I'd really appreciate it, Laura, if you'd come back next board meeting, maybe 2 board meetings from now, and God help me, I'm going to ask this, Laura, but come back and kind of look at it in perspective and say, yeah, it worked well. Laura, what could we have done better? And I'm not going to put you on the spot, but maybe you and staff come back and say, boy, we waited 9 years to pull the trigger. It clearly worked. Might be another 6, 7, 8 years before we pull that trigger again. Laura, so let's capture the learning from this experience so that the next board can be handed a piece of paper that says this is what we did well and what we could have done better, and now it's your turn. It makes sense, right, Laura?
It does. I think I would put that back on the board and the staff to say that the board changed its governance structure, which was incredibly successful. And then you had the right staff in place and the right CIO who called the meeting at the right time and was willing to go out on a limb and change the allocation quickly. So I think it was a success on the board and staff's part quite a bit.
Yep, I bingo, Laura, exactly. So maybe probably you and Laura can kind of link arms and a board meeting or 2 from now, and let's capture this learning for any future board. Yeah, I think you're exactly right, Laura. So like the learning will be a learning to the CIO, to the CEO, to the board, to future people in your role, Laura, and so on. This was a pretty big and significant presentation. Are there any questions from the crowd? If not, Prabhu, back to you.
Thank you, Mr. Chairman. Thank you for your kind comments. And certainly there's some learning here, and we will come back to you in a quarter or so. And with that, I'm going to turn this over back to Laura for 2E.
All right. Okay, can everyone see the Healthcare Trust's presentation?
Yep, we got it. Thanks, Laura.
Great. By the third one, I figured it out. All right. So if we take a look at Healthcare Trust, if you recall, you have sort of the same allocation, except for it all being liquid relative to the pension trust. We actually are talking to staff about how we might want to modify asset allocation, if at all, to be more like the pension, since that was changed recently. So expect some more information on that at a future meeting. And you can see here the current allocations are very close to policy. Growth is still sort of somewhat lower. If you recall, most healthcare trusts tend to be pretty conservative. Your healthcare trust has the same actuarial assumed rate of return as your pension trust, which is now 6.75. So this asset allocation in the healthcare trust, I would say, is still closer to peers than if you were to adjust the growth upward. But we're going to be talking about being intentional about that in incoming quarters. So because the healthcare trust asset allocation tends to be riskier than some peers, you see a return in the 20th percentile of the peer group of similarly sized healthcare trusts, with a return for the quarter of 11.5% relative to 10.7% for the policy. If you look at the fiscal year, you have a return of 2.2% relative to 1.6% for the policy benchmark. But because of being a bit riskier and capturing a bit more of those, the downside in the first quarter than more conservatively positioned healthcare trusts, you see a weaker peer rank for the full fiscal year. All of the managers in this portfolio are the same for the most part, public managers as you have on pension. You can see in particular, emerging markets equity outperformed its benchmark, and growth as a whole was in line with benchmarks. Most of this portfolio is indexed, as you can see in the underlying managers. You have the Russell 3000 index, the MSCI EFA index, and the EM index, and then just active core real estate. And those managers outperformed for all trailing time periods here, except for the 3-year. There is still commodities in this plan. Commodities were down in general for the full year, up quite a bit for the quarter. And you can see the Credit Suisse risk parity benchmark more than doubled the quarterly performance of the benchmark. So I'm happy to take any questions on the healthcare trust, but obviously it's a smaller pool of capital and is invested very similarly just in public options as the pension trust.
Great, thanks, Laura. Andrew, any questions?
No questions.
Sunita, any questions?
I'm sort of the newest member of the block, so can you just help me understand what the healthcare trust is? Might be a basic question.
Yeah, Roberto, do you want to take that one?
Sure, I'm happy to do that. So the Office of Retirement Services actually administer two things. One is the pension benefit, for which we have the pension plan that we had just been discussing. The other retirement benefit that is afforded by the employer to its members is what is known as other retirement benefits, also known as health care. And so they need to work 15 years at the city to be able to earn that benefit. This benefit is no longer afforded to members. It's sort of a closed plan, but we do have many members that are still entitled to a benefit. And just like the pension plan, we do have also healthcare plans under Internal Revenue Code Section 115, where we invest the funds, and that's what we are referring to here, the healthcare plan.
Thanks. That was very helpful.
Yeah, thanks. Yes, and it was something that was put on us in my tenure here. I don't remember if it was a change in law or policy, but it wasn't something we were doing 10 years ago.
It was
any other questions? Go ahead, Roberto.
No, Joe, I was just going to say it was a change, a requirement by GAAP to start.
Oh, that's right. Yeah, that's right. Yeah.
There were, there was a difference between offering a benefit and whether members had a vested earned benefit to the healthcare. And in this particular case, that was the case. So it required the implementation. I don't know if it was just GAAP. I know council is also in the meeting, or whether it was a federal law, but it required implementation of the pension plan, and that's how it came about. You're correct, some 18 years ago.
Yeah, it was a funding issue from Gadsby for the Government Accounting Standing Board to require pre-funding, because prior to that it was a pay-as-you-go.
Yeah, and pre-funding things this big always makes a lot of sense. Sunita, any other questions?
No, thank you very much.
Howard, any questions?
No, thank you. It was very good.
Yeah, Eshvar, any questions?
Yeah, a couple of questions. One is, do we do formal asset allocation for this?
We do. It often is sort of on the back burner behind the pension trust, mainly because of the difference in asset size at, almost 4 billion versus, less than 200 million. And so that's something that we're talking to staff about right now. That's a great question, because we'd like it to be on the same cycle annually around the first to second quarter, but often the pension trust asset allocation sort of takes, several meetings. And by that point, we're almost to the next sort of asset allocation review that happens annually. So we're currently talking, as I mentioned, with the actuarial assumed rate of return being the same as the pension. We're currently talking to the actuary. Will there be any changes there, or should we go ahead and update this asset allocation now, sort of mid-cycle, to make it more like the pension? So I would expect to hear more on that very shortly.
Okay. Yeah, I mean, I guess ideally, maybe you put it in the same cycle. I know asset allocation is one of the responsibilities of the board, And maybe if you sync it together, you're more likely to do it,
Yes, that is our goal.
Yeah. The second is there, I know we want this to be liquid, but is there a reason we don't use active managers? I know we've talked about certain areas where active managers can add value.
We have used active managers in this trust in the past. One of the issues is that the small asset size often means that we can't access the same vehicles. So you often, if you go active, have much higher fees to do, say, a mutual fund, because you don't necessarily get that same benefit of the large asset size. And if managers are able, they will treat both funds as sort of the same client and be flexible, but sometimes they don't have that flexibility if we have to use a different, publicly regulated vehicle. So it's been a little bit more difficult to use active and get the same low fees that we do on the pension.
Is that something we're exploring where, if you have a large allocation from the fund to a manager, that they treat it as just an add-on and give you the same fee?
If they can do that, they will, but sometimes there's not. For example, a separate account or a commingled fund might have a very low minimum that, they can't accept a lower amount. And some mutual fund share classes are regulated in terms of what asset size can go into them. So we have had some active managers here in the past and are not opposed to doing it in the future, but it's been a little bit trickier from the minimum investment perspective.
Okay, thank you. That's all I had, Drew.
Thanks, Ashfar. Nick, any questions from you? I'll take that as a no. Dick, any questions from you?
No, thank you.
Franco, any questions?
Nope.
None for me. Again, Laura, usual thorough job. Thank you so very much.
Thank you all very much. Take care.
Yeah, okay. You too. Prabhu, that's the end of your section. Any final thoughts?
No further thoughts, Mr. Chairman. Thanks again to Laura and Casey for their excellent presentations.
Yeah, thanks to you too, Casey, very much. That brings us then to section 3, which is the old business continued deferred items. Roberto, I'm going to turn this over to you. I noticed the memos from Jennifer, and I see Cheryl's. Hi, Cheryl. I see Cheryl there too. So go ahead, Roberto. Why don't you take this one?
Thank you, Mr. Chair. So as you noted, Cheryl is on the meeting. We'll turn this over to Cheryl in a second. The memorandum came from the city, Jennifer Chambry, and Cheryl is ready to speak to it. It's just a short reminder, a quick reminder. This has to do with a prior board decision regarding Tier 1 rehires. These are members that have prior Tier 1 members of the plan, left the plan for another job, and then came back and were rehired by the city. And so that's what this particular, and when they came back initially, in some cases, they were to Tier 2. And so now they're allowed to purchase that time as Tier 1 members, the time that they have already worked. And so, of course, there's a cost associated with the difference in terms of the benefit structure between Tier 1 and Tier 2. And so they were allowed to join so long as also they pay for the difference of the two so they can get Tier 1 retirement benefits. And so you may recall this was a long discussion some time back. And so that's really the sort of the basic premise for the discussion. With that, I'll turn it over to Cheryl for the latest request by the city. Cheryl, welcome.
Thank you so much. Glad to be here today. So Roberto really did a great job of summarizing why we're here today. And there's really two things we want the board to know about. One is that the ordinance that your board reviewed in June was approved by the City Council for a second reading at the beginning of August. So what that means is that your actuary, Chiron, has been working on a couple of things. One is that we're stopping the future interest accrual for our Tier 1 rehires. As you may recall, that interest rate was the same as the discount rate, 6.75. We're stopping that as of September 3rd. So what that means is we need to calculate what the payment is going to be for the city, because you may recall that ordinance said that the city will be paying the estimated future interest costs. And so Chiron is currently running that calculation behind the scenes. And then the second thing is that Chiron also produces an annual report for our Tier 1 rehired employees so that they know what their outstanding balance is. Because as Roberto said, each individual person has a payback amount for their time that used to be Tier 2, now is Tier 1. Now, with that, I'm getting to the second part of my memo, which actually asks this board for action. So as I said, Chiron does do an annual report so that each person does know how much they have left over the year. But with the Office of Retirement Services Member Direct portal, these members actually have the ability to view their amount, their outstanding balance on a pay period by pay period basis, which is actually a more up-to-date, more real-time scenario. So what we're here to ask today is that the board recommends or approves that instead of doing an annual statement, we actually move to communicate to members to go view and sign up for a member direct portal so that they have these up-to-date, they're able to view these outstanding balances more on an up-to-date basis. So we're here today to ask that instead of an annual statement that we just direct members to go to the member direct portal. Interest was actually not included before, but Chiron is working to include interest in those member direct portals. So once they get those calculated, they'll be in there, and that's when we'll be communicating with those Tier 1 hires to solely use that that technological advance, if you will, for that purpose. So I'm here to answer any questions, but we are asking that the board does approve moving.
Barbara, I just want to confirm that as Cheryl indicated, when we turn this over to the member portal, once we get the download from the city, then the member portal is going to be able to provide up-to-date balances for the members, once they make their whatever bi-weekly payments on their contributions. Is that correct?
That's correct, yes.
So with that said, I'm perfectly fine implementing the recommendation, the request by the city. I wonder if it may be, I know council has a comment on this. I wonder if it would be helpful, maybe for the foreseeable future, maybe for the first couple of years, to, in addition to having the member portal, maybe we do still provide some kind of an annual statement as a June 30th early on, and then we can drop off that once we feel that everything is working correctly. It's just a thought. We don't really have to do it, but if the board will feel more comfortable, we're happy to do that as well.
Harvey, anything you want to comment?
Well, yeah, I was going to ask that question that Roberto posed. It seems to me that would be not costly and a good service, not only to give the members access to the member portal, but also to generate the year-end statement that would go to them. That way, they'll receive that the way they would a W-2 form or something at the end of the year that'll have the year-end annual information on it. So I'm just wondering whether or not, unless that's a burden to staff, why don't we do both and give the member as much information as we can in two different ways?
Harvey, I think obviously we'll add just a tad of a further work, but given that it's only about 20 members, I don't think it's going to be really costly or overbearing. So unless Barbara has any other thoughts, I would say, and then of course, Cheryl, I would think that the city wouldn't object to our office providing an annual statement, at least for the early couple of years until, everybody makes sure that this is working as intended.
I don't believe we have any objections to that. Okay. I agree that more information is always better. I think we just wanted to save a couple bucks here and there by not having Chiron to do the work for the boards or for the employees, but we're happy to continue with that for the foreseeable future. And we can definitely talk in the next year and see how successful this has been.
Very good. We can do that. And ideally that June 30th statement balance will match the balance that is in the member portal.
That'll be the test.
That's always good. So, okay, Barbara, any other final thoughts?
No, but you did just mention something, June 30th. June 30th isn't always the end of a pay period. And so it would be, you know, the pay period that's closest to
the end of the year, fiscal year.
Just to be clear, yeah.
Understood. As soon as we make it clear in the statement, that's fine.
So you're envisaging this to be a fiscal year, because we do also send out to every single member statements for the calendar year, and we do that usually in around January, February, and that the information on balance for these group of people could be incorporated into that annual statement.
So yeah, I mean, I'm not opposed to that. I think I think we'll take the direction from the board, but we'll make it in whichever way makes the most sense for the members. But let me ask you a question. Currently, the statement that is prepared by Chiron was prepared as of June 30th or as a calendar year?
That was of June 30th.
So that's where I was coming from. So why don't we have a discussion with Chiron? I'm assuming there won't be any need for further Chiron calculations because we're not going to be accruing any further interest.
Yes, that's what I was.
But nevertheless, let's work it out with Chiron, and then we can decide and let the board know whether we went with the June 30th or December 31st balance. Is that okay?
Yes.
Okay, very well. So I think, you know, again, we are fine with the request, and except for the fact that we'll come back to you, board, with letting you know whether we ended up with the June 30th or December 31st number. If that's the direction by the board, we're happy to proceed in that fashion.
Great, thanks, Roberto. Well, being your psychic chairman, I'm sensing a real kumbaya moment here. And since our council, and I got Nan's class, says we're not going to vote, how about we take a book from the weddings, take a page from the weddings playbook. If anyone has any objections, speak now or forever hold your peace. Hearing none, I now declare the city and our staff to be a happily wedded couple who will, as Roberto says, come back to us in the near future. You guys missed me when I was chairman, didn't you?
Oh, yeah.
Roberto, I'm going to turn it over to you for 4A through D, and then you can turn it back to me for 4C and 4D, the votes. And Cheryl, thanks. Great to see you.
Thank you so much.
Over to you, Roberto.
Have a great rest of your meeting.
Thank you, Cheryl. Thank you, Mr. Chair. So it'll be quick or an update, and then of course 4B will go to the City Council liaison. Just want to remind the board, staff continues to work remotely. Please note that board meetings will be held via Zoom clearly through the end of the calendar year, quite possibly, although it hasn't been decided yet, quite possibly through the end of the fiscal year. And also wanted to let you know, I have spoken about this before in the Mayora update, but we continue working remotely, performing all our core duties. And I suspect there's a good chance we're not going to be coming back to the office until possibly 2021. So it's not a final issue, but keeping that in mind, we recently introduced a checkout procedures of equipment for staff. We had a quarterly staff meeting last Friday where we introduced the new forms so we can have staff take out monitors or chairs or anything that will help them perform their work from home a little easier. I also want to let you know that the benefits health fair, which is usually take place in October and November, will be held virtually this year. It will not be obviously at the office as we've done in the past. In the 5th floor, it will be virtual. During that health fair, we usually provide flu shots that are free. And of course, since we are not going to be having the actual in-person health fair, flu shots will not be provided. And of course, retiree members have the whole month of November to make their decisions in terms of healthcare. And lastly, I shared with you some time back that our senior internal auditor left the office late June for another position within the city. And we went ahead and requested from the city to unfreeze the position to do a search. That search closed yesterday. And so we did get 5 to 8 candidates, which we're going to be reviewing and hopefully interviewing shortly. So we will keep you posted. That concludes my comments, Mr. Chair. I'm happy to answer any questions.
Before I call the roll call, let me jump in, Roberto. You know, I think you're smart about sort of, we're working differently, so how can we help our workers? And we run across this in almost every startup I'm at. And the 3 things we found that we can help people with, and I know you guys are thinking about this, Barbara, too. Let's see, faster internet. I know you've talked about laptops and monitors, and it's turning out all of our startups actually giving people better internet, faster computers and monitors pays itself back in a month or 2 or 3 with the increased productivity. So you don't need to respond to that, Roberto. I know you brought it up. I just want to let you, that's a little input from startup world. Andrew, any questions for Roberto? Okay, that's probably no. Sunita, any questions for Roberto? Okay, that's probably no. Howard, any questions for Roberto?
One question, Roberto. How is the mood and morale and everything on the staff?
That's a good question, Howard. It is hard to say, to be honest. And I'm going to take this opportunity to say this, obviously, which I was going to mention at the end. I want to take the opportunity to publicly thank staff for their engagement and their work through this pandemic and working remotely. As I indicated before, we have continued performing our core duties, and that's really not an easy task. And from the get-go, staff have been very engaged with the work. So I don't know if that answered your question, but we continue moving forward. I think it is tough. I would expect staff, like any other person, after so many months, and also understanding that this may be the state of the game for the next 3 to 6 months. They may be getting fatigued, clearly. And we had our quarterly meeting last Friday, and we have full participation, which is always a plus. It tells me that there's still engagement. Not as many pictures of Zoom meetings, right? It was a Zoom meeting, so I always like to see their faces. So there were not as many showing their face, so it's hard for me to really get a sense on how they're feeling. But I can tell you that one of the things that came out of that meeting is that they agree that going forward, they're from time to time, they're either going to schedule a lunch hour among some of them, or even a social hour after 5 o'clock as well. So bottom line is, I think there's still full engagement, although I can tell you personally, there is some fatigue about continue working remotely and getting the work done, which is one of the reasons, as Vice Chair Lance indicated, we're trying to be mindful of that and be helpful to help them working from home with allowing them to get equipment from the office.
Yeah, it's not easy, and I think you're doing a good job trying to keep it together. Thanks.
Great. Eshfar, any questions for Roberto?
Nothing from me. Thank you, Drew.
Great. Nick, any questions?
Can you hear me now?
Yeah.
Jiminy Christmas. Thank you. And for the sixth
we could always see you. We knew you were there.
Yeah, no questions. Thank you, Roberto.
Yeah. Dick, any questions for Roberto?
No, thank you.
Great. And Franco? I'll take that to be a no. Next time on the agenda, Councilmember Foley. How's the city doing?
Oh, we're doing so great.
just a couple of things. First, I want to thank all of the firefighters for their tremendous efforts in fighting the wildfires that are surrounding us.
Amen.
In the working with CAL FIRES and the mutual aid, so many firefighters from San Jose are out there helping in any way they can, and also protecting our own environment, our own city. So I just want to give a shout out and a thank you to all the firefighters for all of their energies. And I know some who live up in the Santa Cruz Mountains have lost their homes or have their homes their personal homes at risk too. So the commitment and personal commitment they have made and sacrifices they made, I am truly grateful for, and I know our community is grateful for. So I wanted to start with that and say thank you. Just a couple of things. At the council meeting on Tuesday, we passed a commercial leakage fee, and not to get too much in the weeds on it, but this is a fee that will be imposed on developers of a variety of different properties in order to fund affordable housing. So this fee, we've been talking about it, I guess, for many years, but I've been talking about it for a year and a half on the council. And we did implement a fee that will be implemented on resident or commercial, high-rise, downtown, all types of development. Some development projects are exempt, such as retail. And the reason for that is that we're very concerned about the success of our retail businesses right now. But we will also take a look at this in a couple of years to see how the linkage fee is working, whether we're creating funds for affordable housing. Bottom line is we need to build more affordable housing, and this is a way that we can add funds to help nonprofit developers build affordable housing. The other thing I wanted to talk about is COVID and where we stand, and in relation to our businesses. As you probably all know, we've been now moved into different tier colors, and Santa Clara County is in purple, which means many of our businesses are open. Some of the places that are not, that we have been hearing a tremendous amount from our faith-based, our places of worship. We're getting letters and comments from people constantly, pastors and individuals, who really are missing their opportunity to worship in person. Personally, I am as well. So I bring it up as one of you mentioned, how's the staff doing at the retirement services? And I worry about our staffs, and I worry about our individuals who are home, isolated, sheltering in place, and not able to make that community connection that they really need so much. So today I authored a letter that was sent to Dr. Sarah Cody, encouraging her to allow places of worship to open, of course, implementing our protocols. But I truly believe they can do that. I truly believe they have the capacity and understanding how important it is. And we need to get back to church and worship, however you worship. So many people really need that. It's their connectivity. So I agree with Roberto that we are not likely to be back at City Hall in full force, certainly not through the end of the year. Many are predicting through June of next year. I haven't heard that for sure yet, but it's very hard to work remotely. It's hard to be collaborative it's so important to bounce ideas off very quickly, and you cannot do that. It's hard to be innovative and creative. So I know we're doing the best we can. We're struggling the best we can. Some of the city services have taken a back seat to COVID, but we are also looking at how we can bring back Beautify San Jose and doing our large trash pickups again, and other ways that we can pick up trash on our streets and that sort of thing. So with that, I could go on a long time about COVID, but the new governor's proposal seems to put us in the right direction. Of course, we want our residents to be safe and healthy, but that includes mental health as well as their physical health and well-being. With that, I'll close.
Great.
and
Well,
answer any questions.
certainly on behalf of our active members, thank you for the compliment you've paid to our firefighters. Certainly on behalf of the board, thank you. I live in Portola Valley, well incorporated Santa Clara County, and I'm on the hill, and it came within 2 or 3 miles. So thank you, gentlemen and ladies, for keeping that safe. And Pam, thank you for the thinking about the whole body and spirit, not just can we get our hair cut. So God bless you. I think that is vitally important. Fortunately, the startup companies have kind of reopened because there aren't a lot of people and they sort of have their own small spaces. But I can tell you at every board meeting, our people are saying, "Phew, I didn't realize how nutty I'd gone until I got back to work. And I realized, oh, I really did miss this." So
Yeah.
I think you're right. I think people want to touch and feel and see. So Andrew, over to you. Do you have any questions for Councilmember Foley? Andrew might be off. Sunita, do you have anything?
I just wanted to echo your thanks to to the firemen to sort of help keep all of us very safe. Thank you.
Great. Howard, any questions for Councilmember Foley?
No. Thank you very much, Councilwoman Foley. I appreciate all your work, and especially of the firemen and firewomen who are fighting all the fires.
Yeah. Howard, that was Howard. Sorry, Eshvar.
Yeah, thank you, Drew. So yeah, I'll echo what my other trustees said and what you said, which is I appreciate all the efforts of firemen, firewomen, and all the first responders.
Great, Nick.
No, sir, and thank you, Pam, very much.
Great, Dick.
Thank you, Councilmember Foley. Appreciate the comments for all our first responders, and thank you for the job you're doing. Thank you.
Thanks.
Yeah, and Franco.
Nope, nothing.
Okay, great. Back to you, Roberto. The next 2 items, just remind the board, we will have a vote. So after Roberto presents it, I'll take it back.
Okay, now I'm on mute. Thank you, Mr. Chair. So actually, this item is pretty straightforward. I'll turn it over to Kathleen Schaefer, our benefits manager, for to introduce the item for request of the board. Kathleen?
Yes, good morning to the board. And I would like to second, third, fourth, all those accolades to the firefighters. I live in Monterey County on the edge of the river fire, and they are still out here working, cutting fire lines around our subdivision. So yay to them. This request is a request for an approval on the 4th Amendment to the contract between the City of San Jose Office of Retirement Services and Dr. Tierman, who is the board medical advisor. Dr. Tierman is the one who reads and advises the committee on the independent medical evaluators' reports. Most of us are not medical people, and we do need somebody to decipher it for us, which she does very well. So this is a request to increase funding to the contract. May I answer any questions for anybody?
The motion by me to approve.
Well, let's go ahead and do it that way. Do I have a second to the motion?
I do have a question.
Well, hang on. Let me get a second, and then we'll do questions. Okay. No, fine. Do you want it? Would you like to second it, Sunita?
Not until my question is answered.
Okay, that's good. Anybody want to second the motion? I'll go ahead and second it. We have a motion by Dick Santos, second by Drew Lanza, to approve the extension, the 4th extension of Dr. Tierman's contract. Andrew is not with us anymore. Now, Sunita, go ahead. Sorry, it was a little out of order, but it's all good. Go ahead,
I guess, again, I can keep using this being the newest member of the block for maybe a couple of more months, but can I understand? I mean, it seems a little sort of optically odd that we're increasing this every year by $100,000. Is it just that the demands on her time have gone up, or are there other opportunities to engage with other physicians who might be advisors? I just don't know what the process is. So.
Well, there was an effort to bring in a medical advisory board, and we had put, I believe, 2 RFPs out to which nobody responded, number one. Number two, the reason why this is increased is Each year, she reads reports. She sends us bills every month, and the amount gets used up. I'm now down to about $4,500 left on the contract, and she is continuing to work for us, continuing to provide advice.
So Sunita, let me add to what Catherine just mentioned. This particular service is very specific, and is not every doctor has the ability to provide this service. So there are not that many options out there for medical advisors for disability cases as required under the retirement law of the city of San Jose. So to answer your question, yes, we are very limited to options. Since I've been there for 7 years, in the past, the city actually had a city doctor that provided some service to the members of the plan, and also serve as the medical advisor for the disability committee of the boards. The city actually decided to discontinue that kind of service, which put us in the situation to do an RFP to seek medical advisors. We found someone that worked 1 month and then quit. And so we were able to find Ms. Tierman, who actually served in the capacity of the doctor for the city many years ago, before she went privately. And so she's the only one available right now in the area to provide this service. So we do have many cases, and so this is why she is the only medical advisor available to us to review all the cases. And this particular request is just strictly to the police and fire. And as long as we continue having cases, and I think I don't know if it's in this board meeting, but when we get down to the committees, we actually also provide some statistics on what are the cases that are in the pipeline. There are quite a few cases in the pipeline, and so we need to make sure that she can continue providing the services. So that's why we are coming before you, board, to make sure that she can continue with her work.
Great, thanks. I'm Catherine Roberto. Sunita, any other questions?
Have the cases just been going up every year? Is that why because I'm assuming that the old cases don't get re-reviewed. Or I mean, I know last time we had one, but it's the increase. I'm not questioning the service. I heard her last time. She was terrific. It's just, I'm wondering if that number stabilizes at a point, or you're going to ask for $100,000 incrementally, for the foreseeable future.
I would not expect the number of cases to diminish in the future. I think the reason there are so many in the pipeline right now is that we have some, first of all, we put some of this work on the back burner when the pandemic came. So the committee didn't meet for quite a few months. We started meeting last month. So that added to the number of cases in the pipeline. But in terms of cases coming in the future, in my experience, that it's pretty consistent. So I would not expect the number of cases to diminish in the future.
Roberto, let me add to that. At least on the police side, we have a program that was referred to as exempt employee, which allowed officers that were injured and could no longer do full duty to work in different areas of the police department. That program has been changed. Once you become permanent and stationary, you have to exit the program, and that's going to put them into a disability retirement, whether it's an on-duty or off-duty retirement. So that pipeline is going to start unloading right now, and there's, I believe, 26 people in that program. So you're going to see a kind of a big rush probably through the rest of the year, maybe into next year, because they'll have 1 year to kind of get that thing going. So that's going to be part of it.
Thank you.
Great. Any other questions, Sunita?
No, nothing else.
Those were all really good questions. The disability process, it turns out, is very time people are often sitting in the queue for 3 or 4 years, waiting for them to become permanent stationary. Yes, I'm disabled stuff. So it's an excellent question. Howard, any questions?
Yeah, Catherine or Roberto, just a question. Is the original agreement happened and then there are a bunch of extensions. Is each extension by time or is it just by amount of money that's needed for the forecasted number of cases coming up? Because this one looks like it's good until there's enough for July 2021. How is it based? By time or by just funds?
It's by funds. We asked for an amendment, and then when the funds get low, I get notified by accounting, and then I put in a request for an amendment.
Okay. All right. Thank you.
Great. Eshvar.
Nothing from me. Thank you.
Nick, any questions?
No, sir.
Dick, any questions?
Just a comment to the new members. I can tell you this with all my experience, and I've been involved 54 years. I can tell you this: we're saving money with Dr. Tierman.
Yeah, it's a very, I echo what Dick says, very tight process, and Tierman is sort of the center hub of the system. Franco, any comments?
No.
All right, there is, let me grab, it's, give me a second. There is a motion from Santos, a second from Lanza on item 4C to authorize the extension, Dr. Tierman's contract. Sunita, how do you vote?
Aye.
Howard, how do you vote?
Yes.
Eshvar, how do you vote?
Aye.
Nick?
Aye.
Dick?
Yes.
Franco?
Aye.
And I vote aye as well. So the final item in section 4, do you want to take that one, Roberto?
Yes, thank you, Mr. Vice Chair. So you may recall late last fiscal year, we brought forward, after we implemented the quarterly newsletter, a strategic communication plan, and that was adopted and approved by your board. And what you have before you this morning is actually a plan timeline for the next 24 months, attempting to implement that communication plan. And with that, I'll turn it over to Barbara, who will be presenting the timeline for the strategic communications plan. Barbara?
Thank you, Roberto. So yeah, as you'll see, the plan goes through to June 30th, 2020. And all the activities that are outlined in the plan for this fiscal year, this current fiscal year, they were included in the budget, so the annual budget. And then in future years, the costs will be included in the annual budgets that go to the boards for approval. So just looking here at the plan, we're starting out by obviously the redesign and relaunch of our website. That project is ongoing. It's started, initiated, and we're working on that. And then, of course, there's a push to provide more training and useful tools to our membership, both retirees and actives, by providing, retirement application planning, webinars, short videos, easily digested, and within 2-3 minute videos on topic specific. Most importantly, our upcoming open enrollment. We're going to have a video on that, on how to fill in the form, on transitioning to Medicare, and then in addition to training videos and information resources, we'll continue to publish the newsletter, the Retirement Connection, and incorporate more email blasts out to our retirees so they get information in a variety of ways and in a timely manner. And then going on later on in this year, towards more like December, we're hoping to be launching our Facebook, Twitter. We actually already did incorporate our submission function into the Member Direct portal. So members, either actives or retirees, can get into the portal and send a question and start to connect with our staff. And then we're just going to be building on that, as you'll see. The plan kind of builds on a theme to see if we can build out resources for our for the membership. Have you any questions on the timeline?
Yeah. So if I understand this correctly, Barbara, this is discussion and action. If I'm reading this right, you're saying we're on budget, so there's no action to be taken on that, but I'm guessing after questions come in, you're looking for a motion to approve the timeline. Am I hearing that right?
Yes.
Yeah, great. Okay, let's go ahead and then go down the list. Sunita, any questions for Barbara?
No questions, just a compliment. This looks great.
Yeah. Yeah, the board already knows what I think about Barbara. Howard, any questions?
Hi, Barbara. Just one question. How are things going so far? I know the plan started in, I guess, July. How are things going so far?
Well, they're going. We've got the website project. We're working on that, designing the wireframing, etc. And then, as I say, we kind of plucked at a low-hanging fruit. So there was a functionality within the Member Direct for switching on that message center. So we went ahead and did that. We were reluctant to do that in the very beginning of Member Direct, only because our staff were the application itself was very new. The workflows that were incorporated into the application were very new. And we just felt it might be a little overwhelming at the very start to open up another pipeline. But now our staff are comfortable with the application, and they're getting very comfortable with the Member Direct. And so having work come in through the application is just another way that we can serve our members. And with the COVID situation and working remotely, it also just made sense. It was just the right time to enable it. And so that's been working really nicely. It actually, the work actually comes into the work or the application, and someone can get assigned it. So it's everybody can see who's working on what. And what members have outstanding questions. So far, I think we're doing really well, and we've been talking to some of the vendors for the social media. So yeah, we've been busy, and I think this is achievable.
Great. Looks like a good plan. Thank you.
Thank you. Eshvar, any questions?
No, I'm good. Thank you for the update, Barbara.
Yeah. Nick?
Thank you, Barb. No, sir. Thank you.
Dick?
No, thank you.
Franco?
Nope.
Well, since I sort of already did it, I'll just go ahead and complete it. I move that we approve the timeline that Barbara just presented. Do I have a second?
I'll second, Sunita.
Great. Okay. So item 4D on the strategic communication plan, we have a motion by Vice Chair Lanza and a second by Sunita. So let's go down the list. Sunita, how do you vote?
Aye.
Howard, how do you vote?
Yes.
Eshvar?
Aye.
Nick?
Aye.
Dick?
Yes.
Franco?
Yes.
Great. And this is Vice Chair Lanza. I vote aye as well. That kind of wraps up your section. Any final thoughts or anything you want to add, Roberto?
No, I mean, two things actually. The first one is obviously as we prepare to start working on the fiscal budget for the following year. We know the fiscal year just started, but for 21-22, certainly we will look at the timeline, and if there are any further costs that need to be added to the budget to keep with the implementation on the communications plan, certainly we will address that during the budget discussions. The second one is that we plan on keeping you board apprised, hopefully on a quarterly basis, on where we stand in terms of the timeline as presented for the communications plan. So that's it. Thank you, Mr. Chair.
Great, thanks, Roberto. I think I echo what Sunil just said. I think everybody on this board really is a big backer of this, and good job, Barbara and Roberto. I know communications plans are very intimate, very detailed, and hard to actually implement, but you guys are doing a great job. All right, item 5, service retirements. The retirement of Paul Cook, Police Lieutenant, Police Department, effective September 19th, 2020, with 27.15 years of service. The service retirement of Ruben DeLason, sorry if I mispronounced your name, Police Officer, Police Department, effective September 19th, 2020, with 24.52 years of service. Service retirement of Martin A. Lomelli, Fire Engineer, Fire Department, effective September 5th, 2020, with 28.25 years of service. These guys are all up at only, DeLason almost made 25 years. And the deferred vested Reginald O. Williams, Assistant Fire Chief, Fire Department, effective August 11th, 2020, with 25.27 years of service. Do I have a motion to approve those 3 service retirements and that 1 deferred vested?
Motion to approve.
Great. I've got a motion from Santos, and I'll take it as a second from you, Franco.
Yep.
So let me get down the list. Sunita, how do you vote?
Aye.
Howard?
Yes.
Eshvar?
Aye.
Nick?
Aye.
Dick?
Yes.
Franco?
Aye.
And I, of course, will vote aye. Any comments you want to make on any of those people? Did you ever work for them, Franco, or do you know these folks?
Yeah, I worked around both of those guys. Good people. It's I just think under the current environment that's going on right now, we're just going to see a lot of these guys pull the plug and decide that it's just not worth it to do this job, and that's unfortunate. But again, losing some good experience.
Yeah.
Mr. Chair, I work with both of the firefighters and wish them nothing but the best.
Thanks a lot, Dick. I would now like to announce the deaths of 2 of our members, and we'll have a moment of silence afterward. The death of Ronald Ledesma, Police Sergeant, who retired on May 1st of 1999 and died June 9th of 2020 with no survivorship benefits. And the death of William McQuaid, firefighter, retired January 4th, 2001 and died June 17th, 2020. Survivor benefits to Bonnie McQuaid, his spouse. We'll now have a moment of silence. I don't know if any of you, Nick, Dick, Frank, would like to make comments on either of these gentlemen.
Well, I'll wait for Franco first because it was the police officers first, and I'll make a comment. And Nick.
Yeah, I worked with Ron years ago, and I'd just like to extend, on behalf of the board, our condolences to his family and friends.
Mr. Chair, I knew the Ledesma family, and I knew Sergeant Ledesma. And Bill McQuaid and his brother Bob, they were both veterans of the county and the city of San Jose. And I knew both of them, but I knew Bill before I came on. So it was a friendship, and we'll miss him dearly, and the best to his family. Thank you.
Thank you, gentlemen. All right, now we're into committee minutes, reports, and recommendations. Investment Committee, Eshvar.
Okay, so the last meeting, which was about a week ago, August 25th, the things we discussed, so Christina Investment Officer Christina made a great presentation on our public equity exposures and the different managers. Was very good presentation. Veris did a risk presentation, and that's going to be a quarterly feature from now on. And then we had, we reviewed all the manager decisions, as presented. And then finally, we had a discussion on asset allocation, particularly in terms of our emerging market exposure. And there have been some concerns about that exposure maybe being a tad high compared to a peer group. At the end of, we didn't have consensus in terms of reducing it. So we deferred to the CIO's view that maybe we put it as part of a regular annual feature and make it as part of that discussion, which comes in a few months.
Great. I see there are no action items here. Any questions for Eshvar?
Question for me.
Sure.
The asset allocation sort of bent is given the success of the portfolio and the growth orientation and underperformance of value. Any thought around rotating a little bit, or is that too short-term in nature?
Yeah, we didn't get to that, and that may be something that we should discuss. I mean, I think we briefly touched on it, which is that valuation. The markets are back to where they were before the sell-off, and the question is there more risk than there was, and does it mean we need to take any action? But we didn't go much down that down that lane, and I think as we bring up asset allocation again at the board, that may be something that we should consider. But if you have any particular views in terms of things that we should talk about, whether it's growth versus value, whether it's our overall risk allocation, let me know, and we can. Clearly you're not part of the IC, but we can make it part, maybe part of the board agenda at some point.
I'm happy to add to that question. So we made a decision not to engage in tactical asset allocation. So for a number of years, the boards and staff did engage in TAA. And a couple of years ago, when I took over as CIO, one of the first things that we did was to not engage in any TAA, but to focus on strategic asset allocation. And we've also sort of neutralized any growth and value exposures. And that was one of the things that was presented by Veris. So if you look at our portfolio compared to the benchmark, there are really no active bets in terms of exposures. And we don't feel confident in making those kinds of tactical shifts. I think it's important to get our strategic asset allocation right. And that's what we are focused on.
Any other questions? Thanks, Eshvar. Franco, anything on audit risk you want to bring up?
Mr. Chair, in terms of audit risk, let me.
Go ahead, Roberto.
Well, first of all, just to remind you, if you want to receive and file the minutes for the police and for the IC meetings, that's fine. You can do that later. So the audit risk, actually, we didn't have a quorum at the last meeting, so we couldn't really have these items discussed with your committee. So again, it will be helpful that you approve the minutes that were presented to the committee, because again, the committee didn't meet. I think the quarterly travel and attendance, if I remember correctly, obviously there hasn't been any kind of traveling, so it was a zero cost. But I wanted to key in on items 7.2D and 7.2E. If I don't know if someone is directing the presentation, whether it's Michelle or whether it's Linda, but if you can go into the city auditor recommendations, we had not updated this document in a while, and I made the point. We had an internal meeting, and so what you have before you is the most recent update of the metrics. And so you recall that the city auditor came out with 25 recommendations. 5 were for the city, and 20 recommendations were for our office. Of the 20 recommendations for our office, we have actually completed and implemented 17 of them. So there are 3 that are still outstanding. And while Marty goes to get those items, let me tell you what they are. Is recommendation number 5 was partially implemented. Recommendation 15 is partially implemented, and recommendation 24 is partially implemented. So I'll take them one at a time. Recommendation 5 is have to do with the retirement board should establish a formal budget adoption policies and procedures that include clear delegation of authority to staff to spend plan assets subject to certain limits defined by the boards. And so that particular item is partially implemented. You have been, most of you have been through the last 2 years of the administrative budget. I think we have made great strides in making sure that now what is presented to you board is also presented to the city council. All the documents that you receive are received by the city council, and the dollar figures that you approve are also received by the city council. Where this particular item indicates partially implemented, and you see the target date indicate to be determined, there is one point of contention between our office and the city auditor's office. And as you can read in the document, it has to do, the recommendation by the auditor indicated that investment fees should be part of the administrative expenses. And as you can see there, ORS will update the budget policy to reflect this and have the governance committee and board of trustees approve this change in policy. Many of you know that this recommendation by the city auditor was mostly also based on a legal analysis by the city attorney's office, which indicates that investment fees should be part of the administrative expenses. Your board also received a legal analysis by your general counsel indicating that investment fees are not part of administrative expenses. And in fact, they're just deducted directly from the investments of the plan. And so that's a big difference between the two approaches. We, as you all know, we have made great strides on making sure that we are as transparent as possible. Not only do we include in the annual budget documents to the city council an estimated amount of possible expenses given the most current asset allocation, assuming that the plan is going to earn the assumed rate of return. But on top of that, we present to your board and to the city council a very comprehensive investment expense report that is produced annually by investment staff, and in fact is coming to you next month. And so we do that because we are aware that investment fees are important to everyone as stakeholders, and even though they're not really part of the administrative expenses, the administrative budget that you approve, we want to make sure that we're transparent. For whatever reason, the city auditor is not willing to check this particular item off until we include investment fees as part of the administrative expenses. And so there you have it. I don't see how we're going to be able to reconcile that difference, but I wanted to give you some background. I'm not sure if council have any comments on that, because obviously he wrote the analysis for you. But before he does, if I may, the next two are pretty straightforward. Your joint personnel committee has been working on a formal set of performance measures for the annual evaluation of the CIO and CEO. The reason this is being partially implemented and a target date of June 2021 is noted here is because we're going to have to then reconcile that work by the JPC with with a document that is included in the administrative budget that actually addresses performance measures, not for purposes of the annual performance evaluation of the CEO and CIO, but purposes of performance by the Office of Retirement Services. So has been partially implemented, but we're still working through it. And the last one, I think Barbara just spoke to you at the last item. We're still working through the upgrade of the website. We fully expect the website upgrade to be completed by the end of this calendar year. And so that's why it's partially implemented, and that's why your target date is December 2020. That, Mr. Chair, just concluded my comments on those three items that are still outstanding and partially implemented. I'm happy to answer any questions.
Any questions for Roberto or Franco? If not, hey, thanks, Roberto. I've been a little rusty here. Going back to the investment committee, make note for the record that we receive and file the minutes of both the joint investment committee and the police fire investment committee of May 26th. And on the audit risk committee, make note of the fact that we receive and file the minutes from May 21st, 2020. Governance committee, Nick, report?
Drew,
Yeah,
I'm sorry. I'm sorry, I apologize.
Sure.
I just wanted to also mention on the next item of the agenda on the audit committee, there was the last internal audits that were performed by the senior auditor. They were discussed at the committee level in June, but we had not followed up with the actual written response. And what you have before you is just the written response that was actually putting in writing the discussion and the implementation of the recommendations that were discussed at the committee level at the last meeting in June. And so since your committee was not able to meet this past month, I will ask that your board actually take these 4 items, and I don't have the agenda in front of me right now, but whichever items need to be approved, I will ask that if your board can approve, then that will be helpful.
So I'm showing approval on the minutes, which we've already done, and on the quarterly travel, but the other ones are just updates.
Okay, yes, that's right. So if you did that, then we're all set.
Well, so let's go back to the wedding ceremony. Does anybody have any issues they'd like to bring up to Roberto on any of those 4 items? Hearing none, I think that would normally mean approval, Roberto. So carry on. That covers audit for now?
Yes, that covers audit. You're correct. Yes,
Great.
yes.
Thanks.
Thank you,
Roberto. Nick, anything to report on governance?
No, our meeting today has been canceled. Our next one is scheduled for December, and there are no minutes to approve.
Great. Thanks so much. Dick, anything from the Disability Committee?
Yes, the one thing will be the meeting has been changed to September 8th, which will be next week, not Monday, which will be Labor Day. So make sure everybody knows. And the committee we have with Dr. Tierman and our member Drew Lanza, we're doing a very, very good job. There's been some difficult discussions, but together we address them all, and we within the law. And I have to say, everybody's doing a fine job. Thank you.
Yeah, thank you, Dick. And for the record, note that we receive and file the minutes from the March 9th, 2020 Police and Fire Disability Committee. The last committee is Joint Personnel. Andrew's not here, Vince isn't here. I know Eshfar. Anybody, any comments, or Roberto, anything on Joint Personnel?
Yeah, Mr. Chair. In fact, the Joint Personnel Committee is going to meet again on September 8th. And so I think we'll have a more complete update at your meeting in October, because the items that we're going to be dealing with at your meeting next week are just a continuation from the items at the August 11th. So there's still further work to be done on finalizing the performance measures for the annual performance evaluation for the CEO and CIO, and also some further work on the weighting to be included in those determinations. So again, further discussion to be to be held at your meeting next week. So I think by your October meeting, you have a more, a big, an update on what the end result will be. And of course, everything that is recommended by the JPC will ultimately have to come before your board for approval.
Great. Anything to add, Ashvar?
Now, Roberto covered it all.
Great. Then for the record, let's note that we received and filed the minutes of the Joint Personnel Committee for May 13, 2020. That concludes our agenda. This has got to be some kind of new speed record. I'm
Chair,
back.
Drew,
Yeah.
Drew, may
Yeah.
I
Sure, please.
comment, please? I'm sorry.
No, go ahead, Pam.
I just, something Franco said when we were talking about the retirees just triggered that I haven't given the same shout out to the police department as I just did to the fire department. So I wanted to emphasize how important their work is as well, and how I value every day the work that they do to put their lives at risk in protecting the residents of our city. I have calls from residents all the time about issues in their neighborhood, and the police are out there very quickly to respond, whatever that is, be it a small issue or a large issue. And I didn't want to leave this meeting without also acknowledging how important their work is too. And I also recognize that we are losing really good men and women because of the stress and the conditions that they are operating under right now. So I am so grateful for your personal commitments as well to our city and our residents. Thank you.
Well, and I've been doing this almost a decade, and I realized that the city and the police and fire unions don't always get along. But then I tune in the evening news to Portland and Seattle. So thank you to the city for keeping things relatively at peace and for saying those good words about those of our members who serve. Any other comments? Anything else to add to the next agenda?
Excuse me, Drew?
Yeah.
Staff doesn't have a motion or vote on the audit for the travel analysis and for the minutes.
Well, there wouldn't be a motion and vote, right? It's just receive and file, but hang on, Linda.
Okay.
Harvey, it's just receive and file. We don't have a vote on the minutes, do we?
Not on the minutes, no. I wasn't picking up which, because it's not showing.
Yeah, I'm
on the
looking, Linda.
screen.
I don't see any action on 4A through E. Am I looking wrong?
Drew, so
Yeah.
Because the police and fire audit committee did not meet, those items were not approved at the committee level. So we're asking for an approval at the board.
Motion by Santos.
Well, hang on. So Harvey, how do we proceed since the agenda doesn't say to take action?
First of all, I'd like to see on the screen what we're talking about.
Yeah, can you pull that up, Linda, 7.2A through E? There you go.
Items B and C.
So the minutes 7B and B minutes were received and filed.
Right.
You're saying they weren't approved by the committee.
Yeah, because the committee did not meet.
Well, then they should go back and be approved by the committee at the committee's next meeting, and then received and filed by the board.
Right.
The board can't approve the committee's minutes without the committee approving its own minutes.
All right, Linda gets the award for catching a high pop fly to center field deep. Good catch. Catch. All right, so for the record, the board could not receive and file those because they weren't stamped as approved by the committee. So good catch, Linda. But we can't vote on anything else because there's no action on those now in the agenda. Anything else? Going once, going twice. We're done.
Very good, Drew. Thank you so much. So
Yeah, thank you, everybody.
You led the
Thank you.
meeting and we finish by 11. When it's either Vince or Andrew, we go to 1 o'clock. I don't know what to tell you.
Well, if they were here and we were going to break the record, I'm sure they'd have brought something up. But thank you very much, all to all the members and staff, and thank you, Councilmember Foley, for your kind words. I'm out.
Thank you, everyone. Very well.
The recording.